We'll go to chapter 22. Analysis and interpretation. So as a business, you would have prepared your statement of financial, you would have prepared your financial statement, which means you have prepared your income statement and your statement of financial position as a company. So it is important to analyze and interpret this financial statement. Why? Because when you're able to analyze and interpret, you'll be able, as a business, to have access, to be able to assess. Are you with me, please?
Yes.
When you are, why is it important to analyze and interpret your financial statement? It is important to interpret the financial statement because it allows you to assess the progress and the performance of the business. That's why it's important to analyze and interpret. And when you're talking about this analysis, you're going to analyze the profit, you're going to analyze the return on capital. So let's see what they wrote here. Introduction. It is necessary to analyze and interpret the financial statement of a business in order to assess its performance and progress, like I said. So analysis consists of detailed examination of the information in a set of financial statements of a business. So you get detailed information about your financial statement. That is an analysis. So the result of this analysis are then interpreted in order to assess the performance of the business. So as soon as you are done with this analysis, then you'll be able to interpret it to base the performance. If the business is doing well or not doing well, then you can take decision. So interpretation can include comparing the results to the results of other similar businesses and also comparing within the business with the results of for previous years and with targets and budgets. So you can do this analysis to compare your previous financial statement or to compare other competitors. So these are reasons why we analyze or we interpret. So to enable this comparison to be carried out in a meaningful way, the results are usually expressed as accounting ratios. This is a general term which includes calculation in the form of ratios, percentages, and time periods. Ratios are usually divided into two main groups, which is profitability ratios and liquidity ratio. So for profitability ratio, we're talking about how profitable the business is. That means you're comparing the profit with other financial items within the business. And for liquidity, you want to know how much more in cash you have or less you have. So before we go down, the last paragraph, they talked about working capital. So what is working capital? They say working capital is the difference between the current assets and the current liability, and it's the amount available for the day-to-day running of the business. So the difference between your current assets and current liability is your working capital. So the formula for working capital is current assets minus current liabilities. So these are the money you use for day-to-day running of the business. I think that is clear.
Yes.
That's working capital. Then we have capital owned, which is the amount owed by a business to the owners. So the amount of money the owner of the business has invested into the business is the capital owned. I think that is clear.
Yes.
Then we have capital employed, which is the total funds which are being used by the business. So the total amount of money used by the business is the capital employed. Is it clear?
Mm-hmm.
There's a between working capital, which is the amount of money used in day-to-day running of the business, which is from your current asset, from taking away your current asset from taking away your current liabilities from your current asset. Then we have our capital owned, which is the amount of money the business is owing the owner of the business. Literally, the amount of money the owner of the business has put into the business. Then we have the capital employed. For capital employed, we're talking about the total amount of money, the total amount of fund available for that business. I think those are clear.
Yes.
So for the capital, they said this may be calculated as the owner's capital plus any non-current liabilities. Alternatively, it may be calculated as non-current assets plus net current assets. Listen, they said when you're calculating your capital employed, it is non-current assets plus net current assets. How do you get your net current assets? Net current assets, the total of your current assets plus your non-current assets. That's your capital employed. That means the total amount of money available. Yeah. So we move on. So these are the financial statement, which we have the income statement. We have the profit for the year. The gross profit is there, which we can use them, and we have the statement of financial position. So now we start calculating we start using ratio analysis. So we start with profitability ratio. So when we're talking about profitability ratio, we are talking about a measure of the performance of the business by comparing the profits made with the same set of financial statements. So the profit made, like the profit is from your income statement. The profit you make when you compare it with maybe the amount of capital employed. That is what they're talking about here. So let's see what they talked about profitability ratios here. They said, I used to relate the profit figures to other figures within the same set of financial statements. So we have the first one we can talk about is the ROCE, return on capital employed. When we talk about return on capital employed, we're talking about the return on the investment. And what is capital employed? We say capital employed is the total amount of money, the total amount of fund available for the business, used by the business, okay? So we have our profit for the year. So to get the return on capital employed, it will be profit for the year, which is from your income statement, divided by the capital employed, multiplied by 100. And I believe you understand how we got our capital employed. Your current asset plus your current, your net current asset plus your current non-current asset. I tell it already.
The net current.
Capital employed. We're talking about
capital employed, yeah.
Yeah, capital plus any non-current. Wait, we're talking about capital employed, right?
Yes.
So, well, for capital employed, it is non-current capital plus non-current liabilities.
Yeah.
It's still the same. Non-current assets plus net current. Non-current asset plus net current assets. It's capital employed. So it could also be owner's capital plus non-current liabilities. Your capital, it's going to give you the same value. What I'm saying is, in your financial statement, in your statement of financial position, your non-current, your capital and liabilities accounts, your total liability, will be equal to your total assets.
Yes.
So that means these are your capital employed. The capital employed in here is 155,000. Do you get it now?
155, yeah.
So that means non-current asset plus net non-current asset plus net current asset, or capital plus liability.
Capital plus liability.
Do you get it? Do you get it or not?
Yeah.
So at the end of your statement of financial position, the value you have is your capital employed. The total value you have in your statement of financial position is called the capital employed. Is it clear now?
At this point, it's 155.
So the profit, you check the profit for the year. The profit of the year is 15,000. 15,000 divided by 155. Did you get it? 15,000 divided by 155 multiplied by 100. That is if you are using the financial statements that we have above. I think that is clear.
Yes.
So we have a question. They said walk through. Using the financial statement shown in walk through 22.1. Calculate our loans return on capital employed.
It's not 155. Because it's the same question.
22.1.
Yes, that's 22.1, which has the same financial position. I need to say.
Are you sure it is 22.1?
They said walk through, shown in walk through 22.1.
Okay. All right, let's see what we have here. The profit is 15,000. Profit for the year before interest. What's our profit for the year before interest? Profit plus profit for the year before interest is charged. What is our interest? Profit from operations less profit for the year, less loan interest. So profit for the year before interest is 16,000.
Before the interest, yeah.
Yeah, it's 16,000. So profit for the year before interest divided by capital employed multiplied by 100, right? So profit for the year before interest is 16,000.
Yes.
Our capital employed is, let's see, our capital employed is how much here? We have, what's the difference here? What do we have?
The total of capital without the profit of the year. That's it.
Let's calculate our non-current asset, which is 124,250, right? Yeah, 124,250. That's our non-current assets. 124,250.
Yes.
Plus 8,500, 10,500, 31,250. So how do we have 147? I don't know.
Number 3.
143,000. How is it 143? It's 148, 155. Captain employed. What do we have here? Let's see. Capital. What is the owner's capital? Owner's capital is how much there? Does any non-current liabilities? Well, let's have.
Opening balance was 130.
What's the opening balance? Do you have it?
The capital opening balance 130.
130,000, right?
Yes.
Okay, 130,000 plus non-liabilities. Calculate it for me. Non-current liability is 20,000.
50, that's it.
No, 120,000. Non-current liabilities that we have. It's just loan. 20,000.
Plus 130, which is 150.
So why is it missing? What's missing here?
That-
Our total assets is 123,000.
Total assets.
Yeah, it's 123,000.
No, it's not.
Sorry, our total capital is 123,000.
Plus the non-current. That's it.
Yeah, plus non-current, which is 123,000 plus 20,000. 143.
Yes.
We have capital accounts. Listen, we have capital and liabilities here. For capital, we have opening balance plus profit for the year, less drawing. That gives us capital.
Yes. And
Opening balance plus profit, less drawings, which is 123,000. Then 123,000, which is our capital, plus non-current liabilities, which is 20,000, makes 143,000. So that's 143,000. So it will be 16,000 over 143,000.
so the capital employed, not the profit for the capital employed will be the capital plus the non-current liability.
Yes. So that means that gives us, let's see. So it is profit for the year before interest divided by capital employed. Capital employed is capital plus owner's equity plus non-current assets. Owner's equity plus non-current assets. That's capital employed. So that was done anyway. They'll go to gross profit margin. For gross profit margin, it is your gross profit divided by revenue multiplied by 100. So gross profit divided by revenue.
Revenue is 120.
Gross profit is what? Gross profit is 24,000 divided by revenue. 24,000 divided by revenue. 120,000 multiplied by 100.
20%.
See, that is clear.
Yes.
Then we have, we've talked about that. What else do we have there? So, okay, for gross profit margin, they said, this is also called the gross profit margin as a percentage of turnover, which equals to, okay, let me see what we need to know about it. All right, they said, how can we improve the gross profit margin? We can improve the gross profit margin by increasing the selling price, obtaining cheaper supplies, or changing the properties of different types of goods, proportions. So, the gross profit margin, we're talking about the margin of profit made. So how can you increase your profit margin, gross profit margin? You can only increase it when you increase the price of the product. When you increase the price of the product, your profit margin will increase. Or when you try buying from cheaper raw materials. Okay? And change the proportion of different types of goods sold. That means you try to diversify. You sell product A, product B, product C, not just one kind of product. You can increase your generation, or you can increase your revenue. So that, however, these measures may have some adverse effects. For example, increasing the selling price may result in customer going elsewhere. Obtaining cheaper goods may result in low quality, and so on. So the consequences of buying, of increasing your gross profit margin, if you use increasing price to increase your gross profit margin, it might mean that you're going to lose customers to your competitors. If you are buying cheaper raw materials might mean that they are poor quality, which means the quality you are producing might not be par, which means you might be losing customers too. So if the gross margin changes significantly from one year to another, the cost should be investigated. A fall in the gross margin may be caused by, one, what are the reasons why we have a fall in gross profit margin? One, increasing the rate of trade discounts. When you continue to give trade discount, because they buy in bulk, and you continue to give them trade discount, it will reduce your profit margin.
Yes.
2, selling goods at cheaper prices. When you are selling goods at a cheaper price because you want to attract customers, it will reduce your profit margin. Not passing on increased costs to customers. When there's an increased cost of production and it's not reflecting
The price.
in the price, thank you, then you'll be having a low profit margin. I think the point is clear.
Yes.
Clear, right?
Yes.
All right. So that's all about gross profit margin. So what you need to know about gross profit margin is that first, let's talk about return on capital employed. Return on capital employed is the formula is your, what's it called? The amount of money you invested, your capital employed.
Yes.
The profit for the year before interest. Your capital employed, your profit for the year before interest divided by capital employed multiplied by 100. That's return on capital employed. And your capital, I said, return on capital employed is the profit for the year before interest multiplied by profit for the year before interest multiplied by capital employed divided by capital employed multiplied by 100. Yes. How do you get your profit, or how do you get your return on capital employed? Your return on capital employed is your capital plus, that means owner's equity plus non-current liabilities. That's for return on capital employed. Then gross profit margin. Gross profit margin is gross profit divided by revenue multiplied by 100. So how can you increase your gross profit margin? You can increase your gross profit margin, 1, by increasing the selling price of your product, 2, by buying cheaper raw materials or diversifying the kind of product you sell. That means you sell different kinds of products or changing even your suppliers. But the consequences of selling, or the consequences of using those methods to increase your profit margin is that, 1, when you increase your profit margin by increasing, when you want to increase your profit margin by increasing the price, you might be losing customers to your competitors. When you choose buying cheaper products to increase your profit margin, yes, your cost of production will be less, but cheaper raw materials might mean that you are buying poor quality raw materials, which will have adverse effects on the quality of your product, which might mean that you lose customers. Having said that, then the last thing we need to talk about in gross profit margin is what has to be done whenever gross profit margin is falling. So if gross profit margin is falling, you need to check the trade discount you give to your customers. That means maybe you continue to give them trade discount because they buy in bulk, to encourage them to continue to buy from you. At that point, you'll be losing revenue and you won't be making profit. And if your profit is less, your gross profit margin will be less. The second point is selling goods at a cheaper rate to attract customers. If you are selling goods at a cheaper rate, you'll be losing revenue. And you'll be losing profit. And the last one is not passing on increased cost to customers. When you're not passing increased cost to customers, at that point in time, what happens? Your cost of production. That means your cost of production is increasing, but it's not reflecting in the price you sell. So these are the reasons why you can have a fall in gross profit margin. I think that is clear.
Yes.
Okay. Hold on.